Hello everyone, my name is Rajat and today I am going to talk about IFRS 9. IFRS 9 is a very important model or framework or regulatory requirement, whatever you can call it. Okay. In many of the banks in India, many teams are working on IFRS 9, but nobody in real actually knows what it is. If you are one of those who want to understand IFRS 9 from the perspective of banking and want to do some analytical work on it, this video is for you. Just stay till the end of this video. But before that, if I move on to the work, if you're a very first time on my channel, please subscribe to my channel. Okay. So now let me take you forward. Let's start talking about IFRS 9. So primarily, when you talk about IFRS 9, what comes to your mind? If you are totally from non-banking, nothing comes to your mind, right? You can simply say, okay, so this is IFRS 9. IFRS has a full form. This stands for International Financial Reporting Standards. So IFRS 9 is basically a model which help you to mitigate the risk, especially the credit risk. Okay. Now, very often you guys would be hearing a term in banking, Basel. So usually people have this question every time that what is the difference in a Basel model and a IFRS 9 model. Basel has 1, 2 or 3. So there is Basel 1, Basel 2, Basel 3 and then you have IFRS 9. See, Basel comparing with IFRS 9 does not make any sense, and by the end of this video you will understand, because these are apple, that is oranges. When you are comparing apple with oranges, that does not make any sense. Okay, now let me think it through so that you understand IFRS 9 primarily. Okay, so IFRS 9, first of all, it's known as a framework. Okay, why it's a framework? Because there are so many components which are used in banking. So you can simply understand that IFRS 9 is a impairment framework, primarily framework. Okay, it is used for banking and provisioning of any regulatory standards given by the regulatory body of that particular country. Okay, now let me break it through in simple words. Okay, so IFRS 9 is a framework based on impairment. And the reason of impairment can be anything, maybe loss given by the loans or mortgages, or maybe market crash. I can say market factors. Sorry about my writing, guys. Okay, now IFRS 9 is a framework based on the impairment where there are so many portfolio can be involved. Now, if you talk about the introduction of IFRS 9, so IFRS 9 is used by the banks. Simple. So the first entity in this whole framework is bank. Bank has a sole job of making profit. So obviously banks are not there to serve us, they are there to make profit. So obviously they use all our assets. Let's say we have savings account, we have current account, we have fixed deposit. All these assets are there with bank. But did you know that bank is going to invest this money into risky assets? Invest in risky assets or business simply to make more money. Basically, banks are making money from the money which we are saving with the banks. That's how this whole industry works. Okay, now here there is a concept of provisions. So when you have, these are all things which are low risky things. Obviously, you are getting some interest out of it. You deposit your money in the bank and you get a 4% of interest on savings account. But bank is investing all your money in, let's say, share market, and they are making 20%, 30%, 40%, in some cases 100% also, right? You know about small cap funds, right? Small cap mutual funds and all. So there are so many stuff which bank has to make profit. Now, when bank is making all these profits, to avoid this riskiness, bank usually work on provisions. Provision is a process to keep some money in the pocket to avoid the riskiness, because if the money is totally loosened by the bank, then how bank is going to pay you back? As in, me as a customer will not get my money, right? But that cannot be the case, because the government makes sure that you are not losing your money. Okay, so this is how the business model of the bank works. Now let's move forward. I hope this was clear. Now we'll go to the core part, what I wanted to discuss. Okay, so first of all, in any of the bank, there is a term called financial statements. And who all are here from banking, all of you will understand about it. So in financial statement, the two most important statement every bank check, number one is profit and loss. Profit and loss statement. This is number one. And number two is balance sheet. Now, who all don't know what is profit? Profit is self-explanatory. When I'm selling something, there is a margin in that. That's what my profit is. And loss, everybody know. When I'm investing somewhere, so there is a chance that then I can lose some money. So that is known as a loss. What is a balance sheet? Balance sheet always talks about the assets and the liability classes of the bank. So that's where the balance sheet works. Now, first, let's talk about the profit and loss statement. So when you talk about P&L statement, okay, so it's always works on the concept of net profit versus net loss. What is the meaning of net profit and net loss? After every financial year or after every quarter, what was the net profit we earned after removing all the cost which we involved, and what is a net loss? Okay, so now this profit and loss, which we call P&L statement, is further divided into two parts. Obviously, how can you calculate the profit and loss of anything? There are two things which you need to check here. Number one is income. Income of the bank, how much the bank is earning. Number two is expense. Number one, income. Number two, expense. So this is under your profit and loss statement. Under income, there are two type of income. Just understand this. So you have two type of income. One is your interest based. Second one is non-interest income. Now let me give you an example. What is the interest income? So bank is giving credit cards, bank is giving loan, so many other assets bank is giving to the customer. So bank is obviously making some interest out of that. Home loan, car loan, everywhere bank is making so much of interest. So that is one type of income bank is making. Then there is no interest income. What is that? Let's say when you are applying for loan, so bank is charging so many hidden charges are there, right? That's why we say that you should not take the loan from private banks. Sometimes that happens. But now there are so many other type of fees which are not directly interest, like let's say late fees. Second is when you are applying for a loan, there is a filing fees. All those type of charges which are bank taking from you directly, indirectly are known as not interest income. Okay, this is pretty much clear. Now, what are expenses? Expenses can be in the form of so many things, like for example, sales. So when bank is putting so much money in the sales people, you might have seen those people running in the malls. They are selling credit cards. So there is an expense. That's why you are getting some income. So that is a sales expense. Similarly, if you talk about, let's say, processing. So when bank is going to give any particular loan, before that bank need to do so much of processing, or if bank is going to give a credit card, bank is going to do so much of processing, getting the bureau data, paying to the bureau, all those things. So obviously there are so many processing expense involved here. Okay, I think this is clear. So in profit loss, you have income and income and expense are further divided into two subsequent categories, which you can see here. Now, when I talk about income, okay, so there is a table, let's assume this table. You have income, then you have expense. When you deduct your expense from your income, in the final, you will get your profit. Simple. No mathematics needed in this thing, right? I purchased something for 10 rupees, I sold it for 12 rupees. 2 rupees is my profit. Simple. That's how this works. Now, in this profit, there are so many things which are getting implemented. This profit, which bank is generating, let's say I take the example of Citi Bank. Citibank made so much of profit. Now, in this profit, there are so many things which bank need to do. They have to give the dividend to stakeholders. Now, this concept all of you should know if you are not even investing in the shares. So when you put the money in the shares, you always get some dividend out of that. In most of the good companies, they pay dividend. So the more money you put in the shares of the bank, the more dividend you are getting, obviously. So this is the stakeholder dividend. Then bank has to show the earnings. Why? Because bank has to keep running, right? All those branches are running, the salaries, the electricity bill, and then rent, all those things, earnings, right? From profit only, the dividend will go, number one. Number two, the earnings will also need to be maintained from profit itself. Okay. Then third thing is the provision. Here comes the concept of IFRS 9, provisions. So provision is the money which the bank need to keep safe, let's say, when they need to make sure that the money for the risky customer might be impacted because of the risky customer. That's what I meant. So there is a risky customer, okay? To avoid this riskiness of the customer, bank need to provision some money for this person. Provisioning. So let's say this person can default because of any reason. This person, a person A is there, let's say the name of the person is A. Mr. A has a business which can fail in future. So bank has to assess that and also need to keep some provision with respect to Mr. A, that if Mr. A default, I should be having some money. Now, there is a component here. If you see this is the provision component, then you have the dividend to the stakeholders. Stakeholders cannot be only the bank authority, it can be you and me, right? We are the people who are investing in share market also, right? Obviously the bank higher authority is there, but now if you see, there is a graph we can plot. If we increase the provisions, obviously the dividend will go down. So there is a relationship, there is a linear relationship. Linear relations. So there is a linear relationship between the provisions and dividend. Now, this is a kind of a problematic situation. I'll tell you why. Even if the profit is too much, the bank is increasing, let's say, the provision. So in that case, the dividend cannot be increased because that is a problem, and this problem is known as growth versus sustainability problem. This problem we can call growth versus sustainability. This is the Very big problem many industries suffer from. Okay. Now, couple of things all of you should remember here. So, here comes the IFRS 9 concept, provisions concept. So, IFRS 9 is basically an impairment model which makes sure that you should have the provisions, okay, provision proportionate to impairment. This is the concept of IFRS 9. Okay. Now, one thing all of you should remember. Primarily, IFRS 9 talks about provisions. Okay. IFRS 9 talks about provisions, which basically cater the expected credit loss. We calculate expected credit loss, so IFRS 9 basically directly solve the problem of expected credit loss. Now the second point here is going to be your Basel model. When I mentioned, so this is a difference between IFRS 9 and Basel. Basel is a framework. It's a Basel framework captures unexpected credit loss. Here we were calculating ECL. Here you are calculating UECL, which is your unexpected credit loss. Okay, and this particularly focus on capital adequacy, which basically means that there should be enough capital. So Basel focus on the enough capital. Okay, Basel is a framework which focus on the unexpected credit loss and focus on the adequate enough capital, which we called also CAR, capital adequacy ratio. This is a very important term in the banking sector. So you should know that Basel is very much responsible for this. Okay, now that's one difference between both of them. Now, if you see, the investor will not like all this Basel and all, right? Why? Because if you see investors who are getting dividends, you see here, all these stakeholders which are getting dividend, if the provision is increasing, so dividend is decreasing. But if you see in long term, so because of this provision only, bank is able to function till the end of your life forever. Because bank is doing some risk management, that's why bank is able to function. So in long term, everybody will like the provision, but in short term, all these investors, they sometimes don't like. So long term is basic game here. Okay. So I think this is clear till this point. So IFRS 9 versus Basel is also clear now. Okay. So till this point, we are clear with the IFRS 9. Why we need IFRS 9? So now this was all about, I wanted to talk about P and L statement. Now let's move on to the balance sheet. Let's start from here. Okay. So the topic was balance sheet. As I said, balance sheet is a very simplistic thing. Okay, asset versus liability. In a balance sheet, you will always have this type of structure: asset on one side, second side is liability. What are the assets of the bank? Loan, the biggest asset the bank have. Then properties, physical assets, and so many other things. Okay, what are the liability? Savings account, current account. Also, if I combined all this, so in Basel or IFRS term, you will call it capital. This was the main thing I wanted to highlight. Capital is a liability for a bank. Okay, so capital is a liability, pretty much clear. This capital need to follow the Basel guidelines, which talks about the capital adequacy ratio, which means the capital adequacy ratio should be at least 8% or maybe 9% depending on that. Basel says that while IFRS 9 talks about the provision, there is a difference in the provisions and the capital, enough capital. Okay, so understand that. Now, if you have any question, put it in the comment section. I will reply to that. Sometimes it's tough to understand this. Now, this capital is of type. There are type of capital. The most important one is tier 1 capital. Then you have tier 2 capital. Then you have tier 3 capital. In tier 1, tier 2, tier 3 capital, all these are basically used to procure the money in the pocket of the bank so that bank should be able to function forever. Now let me make a small graph here to understand the expected credit loss and unexpected credit loss. So let's say this is your graph which is going on. Okay, if expected credit loss you are calculating here, okay, then after your expected credit loss, here come the unexpected credit loss. So this is just to simplify the overall concept of expected versus unexpected. Once after the calculation of the expected credit loss, there can be chances then that unexpected credit loss also can occur here. Now, to cater this demand, you have this tier 1, tier 2, all these capital. Now, obviously, tier 1 capital is what? To understand tier 1 capital, you can simply understand it. It's the equity capital. All the money of the investor is invested through equity is kept in the tier 1 capital. That's why it's the most important and base capital which all the bank want to keep in their pocket. Okay, now to cater this unexpected credit loss, always this tier 1 capital is used primarily. The first step will be if there is an unexpected credit loss, so there should be the equity money should be utilized so that bank can function continuously. Now, what is tier 2 capital? This is a subsequent or subset of your tier 1 capital. So once you use, this is nothing, tier 2. This is the 100% utilization of your tier 1 capital. So when you utilize 100% your tier 1 capital, that is known as a tier 2 capital here. Tier 3 capital is in the form of liquid bonds and all that. Okay. Now tier 1 is equity capital. Tier 2 is your subordinate or subset of tier 1 capital. Now to keep intact this tier 1 capital, obviously bank want to keep this tier 1 capital fully safe. So to keep it safe, what bank usually do? Bank perform stress testing. Now, stress testing is a scenario where bank put any particular asset into a stress scenario and try to get the numbers that what will be the impact of this. Now, for that, what are the options bank have? There are some particular tests which are already defined. So which bank tool? Let's say DFAST. DFAST is one of them. CCAR, CCAR model. We call it CCAR. It's a test. Okay. Then there is Basel regulations, obviously. But DFAST and CCAR, these are the most popular one. Okay. Now, with this, I would like to conclude this video. I think this was pretty much clear to all of you that how actually IFRS 9 and Basel works. And in this playlist of credit risk, this is going to be a game-changing concept you all should know because this is going to really help you to get you a good job. Okay. Now I'll see you in the next video. We'll talk about more specifically about impairment and IFRS 9. So I'll see you in the next video. Before that, if you like my video, please hit the like button. Please subscribe to my YouTube channel. And also in this playlist, there are so many important videos about credit bureau, banking functions and all of that. So you should definitely take a look at that. All the best, everybody. Thank you.